So this is the Japanese yen weekly chart, and to go back to what we said before, the currency has been in a up move still, with a period of consolidation, which usually translated into a triangle. And now it looks like after it broke that level here, it went up, and now is or has retraced to almost the trend dragon trend line, and seems to be moving away from that to potentially go back up. That move here has the characteristic of a trending move because uh, moved up here, did retrace, but did not break this level here, which was the previous high, as compared to what happened here in this section here, which was really a corrective move, market ranging. In this case, it looks like the market did not do that and just basically respected that level and didn't go back into that consolidation period. Um, on the weekly also, these two candles seems to have done a reversal pattern on the upside. The only thing is that the week is starting very well, a bit neutral, but a little bit on the downside. So if we'll place our line for the weekly, because I feel they will be helpful for our daily analysis, then we can go into the daily analysis. So on the daily analysis, we can see that they've been a very nice move down, followed by a move back up to that level here, with a little bit of a rejection here, which give us another level anyway. So can't really, we could say that this is a second higher low. So we have 1, 2, and this here could potentially be the third one. In this case, it's quite easy for us to see where to enter the market. You would enter at the break of this level here, which is basically 108.33, and I'll put that in blue so you can see it better. And the objective of this move would be the previous high, 110, 145, with the hope or the objective that it would break that high and resume the move up based on the weekly chart. Okay, trend dragon trend line has turned green again, with a slope going up. Okay, so breaking that level here would probably be a good sign. So what we could expect is a move up, maybe move back down to that level a little bit, and then going back up to break that level. Once you reach that level, maybe a little bit of retracement again, and then shooting up. If you wanted to enter in the upside, what you would have to do is put your stop loss at least at this level or potentially this level here, which would be pip wise, it would be either 200 pip or 350 pip. The upside, minimum upside, I would say, of what would be our first objective would be about 170 pip. Then after that, if we follow the trend line that I have drawn on the weekly chart, the total move could be 500 pip up from that point on. When it did retrace, it did not retrace all the way down to the trend line, and if it actually does break that level here, it may actually be in the process of doing a acceleration. If you draw a line here, you can see that it hugs pretty well. So on protective, I would probably look at if you want a tighter stop loss under the trend dragon trend line or under that level here. Of course, it'd be better to look at the market if it happens to time your entry and tighten your stop loss, to look at lower time frame. On the downside, is a little bit more complicated because there is a level of support here, a strong level of support here, which is daily and weekly. Though if it does break that level here, it could actually go down and break that trend line. Okay, so if it goes down, the downside so far is not as good as the upside. You can expect a lot of support at that level here, which was the previous level of consolidation. We try to trade that way. If you remember, we're always going range trading anyway, so it's quite strong level of support here. So the downside potential is between 100 to 200 pip, and if you take it a bit earlier, maybe 300 pip. It would be a bit risky to do that. So if you take a trade on the downside, I'd be very cautious, because it would be a counter trend anyway. So that's it for the Japanese yen. So I hope that you have a good week. I'll try to do another video on Wednesday to see where we are.